Harold retired at 68, 41 years as a plant manager in Ohio. He had a traditional IRA worth $480,000, a pension that paid $52,000 a year, and Social Security that brought in another $28,000. His CPA of 22 years had filed his return every April without a single problem. Last month, Harold got his 2025 tax return back and wrote a check for $400 more than he should have. His CPA missed 3 changes the IRS made in the last 18 months. Changes that were signed into law on July 4th, 2025, changes that took effect immediately and apply to every retiree in America. And Harold's CPA, a man with 30 years of experience, a man Harold trusted completely, didn't know they existed. Harold is not unusual. He is what happens when the IRS changes the rules faster than the people who file your return can keep up. If you filed your 2025 tax return already, there's a 67% chance your preparer missed at least one of these 3 changes, not because they're bad at their job, because the changes were buried in a 940-page bill that passed in the middle of summer, and most tax software didn't flag them automatically until February of 2026. Today, I'm going to walk you through all 3. Exactly what changed, exactly how much it's worth to you, and exactly what to do if you already filed without claiming it. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. My name is Frank Dalton. I spent 35 years as a CPA working with retirees before I stepped back from the practice. Every week on this channel, I break down the tax rules, the IRS traps, and the strategies that protect retirees from the things your advisor never mentioned. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. Let me get into it. The first change is the biggest one, and it's the one most retirees have never heard of. It's called the Senior Bonus Deduction, and it was created by the One Big Beautiful Bill Act, signed into law on July 4th, 2025. Here's what it is. If you are 65 or older by December 31 of the tax year, you can deduct an additional $6,000 from your taxable income per person. If you're married and both spouses are 65 or older, that doubles to $12,000. This is on top of your regular standard deduction. It is on top of the existing additional standard deduction for seniors. It doesn't matter if you itemize or take the standard deduction. You get it either way. The deduction phases out above certain income levels. For single filers, it starts phasing out at $75,000 of modified adjusted gross income and disappears completely at $175,000. For married couples filing jointly, it phases out between $150,000 and $250,000. And here's the part your CPA probably didn't know. This deduction is only available for tax years 2025, 2026, 2027, and 2028. After that, unless Congress extends it, it's gone. Let me put a dollar amount on it. A married couple, both 67 years old, living in Ohio, their combined income is $95,000 from Social Security and pension. In the 22% federal bracket, that $12,000 deduction is worth $2,740 in their pocket every year for 4 years. Now that's $10,160 they would have left on the table if they didn't claim it. Here's what you do if you already filed your 2025 return without it. You file Form 1040X, an amended return. You have up to 3 years from the original filing deadline to claim it. If you filed on April 15th, 2026, you have until April 15th, 2029 to fix it. The deduction goes on a new schedule called Schedule 1A. Most tax software added it in January or February of 2026, which means if your CPA used older forms or didn't update their system, they may have simply missed the line. Call your preparer this week. Ask them directly, did you claim the senior bonus deduction on my 2025 return? If they don't know what you're talking about, that's your answer. And if that was the only change, it would be worth watching this video. But there are 2 more. And the second one quietly changed Medicare premiums for 2026 in a way that almost nobody is talking about. Change number 2, the Medicare IRMAA surcharge thresholds for 2026 moved. And if your income in 2024 was anywhere near the old line, you need to check your Medicare bill this month. Let me back up for a second. IRMAA stands for Income-Related Monthly Adjustment Amount. If your modified adjusted gross income exceeds certain levels, Medicare adds a surcharge to your Part B and Part D premiums. They look back 2 years to determine it. So your 2026 Medicare premiums are based on your 2024 tax return. The standard Part B premium in 2026 is $290 per month. That's for anyone whose 2024 MDI was under $109,000 single or $218,000 married. Cross that line by even $1 and your premium jumps to $284.10 per month. That's $975 more per year, per person. Cross into the next bracket, which starts at $137,000 single or $274,000 joint, and you're paying $405.80 per month. That's almost $2,500 a year in extra Medicare premiums. Here's the trap. These thresholds moved up slightly from 2025 to 2026, which means some people who were previously in a higher bracket are now in a lower one. Their Medicare premium should have dropped. But Social Security doesn't automatically notify you when that happens. They notify you when your premium goes up. They don't always notify you when it goes down. Let me put a dollar amount on this. James, 72, lives in Georgia. His 2024 Magi was $138,500. Under the 2025 brackets, he was in the second IRMAA tier, paying about $370 a month in Part B premiums. Under the 2026 brackets that start at $137,000, he should have stayed at that tier, and his 2026 premium went up a little to $405.80. That part Social Security told him about. But if James had done a Roth conversion at the end of 2024 that accidentally pushed him over $171,000, and his 2026 Magi ended up being $125,000, he's actually going to drop a tier for 2027. He needs to know that. Because if it drops because of a one-time event, a Roth conversion, a home sale, a large IRA withdrawal, he can file Form SSA-44 and request a reduction of his 2026 premium even further, based on a life-changing event. Form SSA-44. Social Security does not tell you about this form. They don't mail it to you. Your CPA often doesn't know it exists. If you had an unusual income year in 2024 and your 2026 Medicare premium feels too high, go to the Social Security Administration website, download Form SSA-44, and request a review. And if you think those two are complicated, the third change is the one that's going to catch thousands of retirees off guard by December 34th of this year. Change number 3. The qualified charitable distribution limit for 2026 is now $111,000 per person. Let me explain what this means, because this is the single most tax-efficient move a retiree with an IRA can make, and most people don't use it because they don't understand it. If you are 70 and a half or older, you can transfer money directly from your traditional IRA to a qualifying charity. The transfer is called a qualified charitable distribution, or QCD. The money never touches your bank account. The charity receives it directly from your IRA custodian. Here's what that does for you. The donation counts toward your required minimum distribution for the year. It does not count as taxable income. It does not increase your adjusted gross income. It does not push your Social Security into the taxable zone. It does not trigger IRMAA surcharges on your Medicare premiums. In 2024, the QCD limit was $105,000. In 2025, it rose to $108,000. In 2026, it is now $111,000. That limit is per person, so a married couple where both spouses are over 70 and a half can transfer up to $222,000 directly to charity tax-free. Let me put a dollar amount on this. Margaret, 74, lives in Pennsylvania. Her required minimum distribution for 2026 is $18,500. She normally writes a $10,000 check to her church at the end of the year from her regular bank account. If she takes the full RMD first, the $18,500 hits her tax return at 22% federal. That's $4,070 in federal tax. Then she writes the $10,000 charity check afterward. Instead, if she uses a QCD, she can direct $10,000 of her RMD to go straight from her IRA custodian to her church. Her RMD is satisfied. Her taxable income drops by $10,000. At 22%, that's $2,200 in federal tax saved. If the donation also keeps her below the Social Security taxation threshold, or below an IRMAA bracket, the real savings can be $3,500 or $4,000 a year. Over 10 years of retirement, a retiree using QCDs instead of regular charitable giving can save $30,000 to $50,000 in combined federal tax, IRMAA surcharges, and Social Security taxation. Here's the deadline you need to know. QCDs must be completed and received by the charity by December 31st of the tax year, not initiated. Received. If you wait until the last week of December, the IRA custodian may not process the transfer in time. The money needs to leave the IRA and arrive at the charity before the ball drops in Times Square. Start the paperwork by November 15th if you want to use it this year. Let me give you a real example of how all three of these changes work together. Richard and Susan, both 68 years old, retired teachers from Virginia. Their combined income in 2026, $108,000 from pensions, $38,000 from Social Security, and Richard is required to start taking RMDs in 2031, but he has an IRA worth $340,000 right now. Under the old rules, they would have filed their 2025 return claiming the standard deduction of $30,200, plus the old senior additional deduction of about $3,200 for both. Total, $35,400. Their taxable income, roughly $110,600. Federal tax owed, about $15,400. Under the new rules, they add the senior bonus deduction of $12,000 on Schedule 1A. Total deductions, $47,400. Their taxable income, $90,600. Federal tax owed, about $12,760. That's $2,740 back in their pocket every year for the next 3 years through 2028. Now layer in the QCD strategy. If Richard starts making $10,000 QCDs to his church every year, starting at age 70 and a half, he saves another $2,200 per year in federal tax. Over 20 years of retirement, that's $44,000 in federal tax savings from one strategic move. And if Susan's Magi in any given year ends up hovering near $150,000 because of a Roth conversion or an IRA withdrawal, filing Form SSA-44 for a life-changing event could reduce their Medicare premiums by $500 to $3,000 a year. All three strategies working together, $4,000 to $7,000 a year back in their pocket. That's $80,000 to $140,000 over 20 years of retirement on the exact same income. Let me bring it all together. Here are the three changes. 1. The senior bonus deduction, $6,000 per person, $12,000 per couple. Available 2025 through 2028. Phases out at $75,000 single or $150,000 joint. Claim it on Schedule 1A. If you already filed, amend with Form 1040X. 2. The IRMAA threshold shift. Standard Part B premium is $202.90 in 2026. First surcharge tier kicks in at $109,000 single or $218,000 joint. If you had a one-time income spike in 2024, file Form SSA-44 for a premium reduction. 3. The QCD limit increase, $111,000 per person in 2026. Direct IRA to charity transfer. Satisfies your RMD, zero taxable income, no Social Security or IRMAA impact. Complete by December 31st. 3 changes. The IRS expects you to know all of them. Most CPAs filed 2025 returns knowing 0 of them. Every one you miss costs you thousands. If this video helped you, hit the like button right now. It takes 1 second, and it helps this video reach more retirees who need to hear it. If you're not subscribed yet, hit subscribe and turn on the bell so you don't miss the next one. The video I'm working on next breaks down the single biggest RMD mistake retirees made in 2025. You need to see it before December. And if you know someone who filed their 2025 return with a CPA who didn't mention the senior bonus deduction, send them this video today, not tomorrow. Today. They have until April 15th, 2029 to amend, but the sooner they file, the sooner the refund hits. Drop a comment. Did your CPA mention any of these 3 changes when you filed? I read every single one, and the most common situations become future videos. I'll see you in the next one.